In this video, we're going to review how to read a call option quote. Remember, an option is a contract between two parties. If you buy a call option, you are buying the right, but not the obligation, to buy a specific number of shares at a specific price for a specific period of time. Let's look at an option quote for Starbucks as an example to see how all of these factors are accounted for in an option quote. We see that the price of the underlying stock, which is Starbucks, is $115.54 per share. But let's say that we think that the share price might go up to $125 in the near term. We could buy a call option on Starbucks to reserve the right to buy it at, say, $120. But remember, option contracts only last for a specific period of time. Reading from left to right, the first thing we have is the type of option, call or put. In this case, we are looking at the call option. Next is the ticker symbol of the underlying stock, Starbucks, which is SBUX. Then we have the expiry date. This is how long the option contract would be exercisable for. In this case, the expiry date is 2021, September 17th. The next number is the strike price. This is the price at which you would have the option to buy shares of Starbucks. In this case, the strike price is $120. Now we have the more familiar bid, ask, last, change, and volume columns. But keep in mind, these are for the option contracts, not the underlying shares of Starbucks. Another very important point, one option contract is normally a contract to buy or sell 100 shares of the underlying stock. So when you see the bid and ask prices, you have to multiply these numbers by 100 in order to buy or sell one option contract. In this case, we see the last price a trade was executed at was 56 cents. If we wanted to buy one call option at this price, we would need roughly 56 cents multiplied by 100, which equals $56 plus the trading commission, which is a little bit higher for options than for stocks. The next column is the open interest. This tells you how many open contracts exist for this strike price and expiry date. It's common to see a lot of zeros here and higher volumes for more popular strike prices, but just because you see a zero doesn't mean a contract can't be created. You can put in a bid, and if someone agrees with the price, they will take the other side of that trade and you will have created a new contract. The last thing we'll point out on this screen is that the shaded rows mean those particular contracts are in the money. That means the strike price for a call option is below the current share price. The shading stops once the strike price is higher than the current share price. This is known as out of the money. If you hold an option contract and it expires out of the money, it's worthless and you will have lost all the money you invested to buy that option. But you can make a positive return if you either sell the option contract before expiry at a price higher than you paid for it, or if you exercise the option to buy the underlying shares at the strike price if the option is in the money, and the difference between the share price and the strike price is greater than the cost to originally buy the option contract and commissions.